Okay, it's showtime. Hi, folks. As you know, our topic today is Annuities 101, Safe Money Planning. And I have to say, this is a really popular topic because so many people today who either are retired or about to retire are looking for safer ways to invest their money. And of course, annuities, because they're usually principal protected, many times come up in conversations between financial advisors and their clients. So, because of that, and the varying opinions that many financial advisors have related to them, many people are confused and hesitant when it comes to annuities. So, because of this, I thought it was time for us to tackle this topic in order to give my perspective on annuities, because every financial advisor has an opinion on them, whether it's good or maybe not so good. And I'm certainly no exception when it comes to that. That being said, right out of the gate, I just want to say that it's been my experience that every single financial vehicle out there today has a time and place where it can be a good option for a client, given whatever their specific situation is. So to me, it's not ever really been the matter of whether some types of annuities are good or bad in general. It's really just whether they're right or wrong for any given situation or not. For instance, I personally have never written a fixed immediate annuity for a client. This is the type of annuity that, in order to get the very highest payment possible, the assets that are invested become irrevocable. This means once you sign on that dotted line, that's it. You start getting a check every month for life, but you can't get your money back no matter what. Plus, to get the very highest monthly benefit from one, the annuitant usually has to forego leaving a death benefit to their beneficiaries as well. However, that does not mean that those terms are unacceptable in every situation. Now, this is only one of many types of annuities, and it's the only one that works like that I know of as well. Oop. All right, let me get in here. So, sorry, I jumped out of my place here. I don't know. Got to get back on my notes here. So it's the only one that I know of that works like that. So this means, hold on. Plus, now, this is the only one of all the types of annuities that I know that work that way, as I said. However, I did consider writing one for a prospective client one time because she was 80 years old with a life expectancy of around 85 to 87, and she needed the very highest monthly benefit amount possible. Plus, she had no significant relatives to leave her money to either. So in my opinion, she was the quintessential customer for this type of annuity. Probably exactly the type that it was created for. However, she's the only person I ever considered for this type of annuity because of the extreme nature of the term. So I think that it's fair to say that some annuities lend themselves to more common situations than others. This particular one for me just has been a lot less common. However, there may be other financial advisors that work more often with folks where this type of annuity is a good fit. This example, among many others, is exactly why I thought that we should take a deeper dive into annuities and examine the most popular types and the pluses and minuses related to them. We'll not only look at the most invested in annuities today and why, but we are going to look at some of the details that you should definitely know a little bit about before you make any decisions on whether an annuity is good for you or not. Things like, what does it mean to annuitize an annuity? What type of annuities are better for income and which for investing for conservative growth? What is a rider and why would you consider adding one to an annuity? What is a fixed account inside an annuity? What are indexing strategies and what should I consider with them? What are the different fees that I should look for in them? And what is guaranteed inside of an annuity and what is not? And that's just to mention a few. So it's our goal today to not only give you the basics when it comes to annuities, but also some of the details that make them appealing and unappealing depending on your goals and preferences. Okay, now that you guys have a clearer understanding of what we're going to cover today, before we jump into it, I'd first like to thank each of you for joining us today to discuss this highly sought after topic. My name is Brian Dougherty of PLC Financial Solutions. I'm your regular host for it today, but unfortunately, my beautiful, wonderful partner in business and life, Rachel Dougherty, who's usually our moderator for all of our webinars, will not be with us tonight because of previous business obligations. She usually handles all the comments and questions as we go along, but for tonight, you guys are stuck with me. I'm on my own, but believe me, I'm going to do my best to hang in there and pick up the slack where Rachel left off. Okay, so before we get started, let's take care of some general housekeeping first. One, if the screen is not big enough for you to read, you can click on the view options drop down at the top right of your screen to make it larger. Two, also, you'll see that there are two boxes at the bottom of your screen. One's called chat. It's for your comments, and the other's called Q&A for your questions. Please use them accordingly, and I will respond in kind. Next, I'm sure that many of you guys will have questions about the material as we go along. However, since we have a good bit to cover and only an hour to do it, I'm going to ask you to hold those comments and questions and put those into the boxes that I just mentioned below, or you could also even email them to me at info@plcfs.com if that's easier for you, because at the end, we'll be staying for some extra time to cover as many of them as possible. However, if I don't cover yours, I'd be happy to answer it either by email later or even a 15-minute Q&A phone call scheduled for another time. And I'm going to be posting, I already did post the links to those in the comment box if you want to take a look. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it out again at your convenience. Also, because we want to make sure that you're all paying attention, and because we'd like you to have some fun as well, before we answer any questions, we have a 6-question quiz for you at the end, and the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of their choice. So make sure you have a notebook handy to jot down some notes related to some very special bullet points, and I'm going to make that gesture that I'll point out as we are going along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. So now that we got that over with, I have one for you as always. And I actually got this from my younger son, Com. He said that he actually made it up himself, which I was pretty impressed with, actually. So here it goes. What do you call a duck on drugs? A quackhead. I thought that was awesome. I can't believe he came up with that on his own. All right, all right. So I'll stick with the day job. All right, so let's get started. Okay, now before we get too deep into the specifics related to different annuities, let's take a brief look at the history of annuities and the historical basic function of them. So I Googled when were annuities first introduced in America, and I got this. Annuities made their first mark in America during the 18th century. In 1759, a company in Pennsylvania, in our own very own state, was formed to benefit Presbyterian ministers and their families. The ministers would contribute to the fund in exchange for lifetime payments. However, it wasn't until 1912 that Americans could actually buy annuities outside of a group. The Pennsylvania Company for Insurance on Lives and Granting Annuities was the very first American company to offer annuities to the general public. Moreover, I also Googled, how did the first individual annuities work? And I got this. An annuity is a long-term investment that is issued by an insurance company and is designed to help protect you from bullet point. So write this down. It's a bullet point. From the risk of outliving your income. So what risk were they created for? The risk of outliving your income. All right. Through annuitization, you purchase payments, and what you contribute is then converted into periodic payments that can last for life. The key word in this last definition is annuitization, because one, it's where the name annuity came from. And two, it was through this process that a customer was able to generate an income for life. So how is the word annuitization defined? There are several definitions, but the simplest one I could find was this. Annuitization converts an annuity investment into regular payments. Now, these payments can be made over the remainder of someone's life or over a certain period of time, depending on the payout options that are offered and are chosen by an annuitant. Okay, let's leave it at that for now, because I think that that at least lays enough groundwork for us to move forward with this point. So, what are the most commonly used annuities today, and how do they work? Well, there are actually several different annuities that have been created to fill certain needs. And bullet point, second bullet point, write this down. The most commonly used annuities today, though, are one, fixed annuities, also known as FAs. Two, fixed indexed annuities, also known as FIAs. And three, variable annuities, also known as just plain VAs. Furthermore, all three of these types of annuities can also be classified in two more ways, which are immediate annuities and deferred annuities, depending on the customer's needs. This, of course, refers to whether an annuity is put into use right away, hence immediately, or at a later date, hence deferred. Now, let's look at each of these annuities types and how they work. Okay, when it comes to fixed annuities, the basic characteristics of them is that they offer a fixed rate of return throughout the entire life of the annuity. This is the original annuity. It will guarantee a certain upfront rate of return, which these days is usually around, it was around 2%. It's actually getting upwards around 5%. Or slightly less, depending on the amount of time that you decide to do it, and the length of the terms of the contract. And generally, does not come with any income-based riders, which we'll explain in a minute. So to get income for life, from one of these, you usually have to annuitize the contract. Now, there is another type of fixed annuity that's out there today that does not offer any income options, but does offer very competitive short-term returns. It's called a multi-year guaranteed annuity, or for short, a MYGA. They're mainly sold to compete directly with short and medium duration CDs and bonds, and they work very similar to them as well. But they have historically offered higher returns than both, actually. Currently, as of yesterday, the range for a 2-year to a 5-year is anywhere from 4 to north of 5%. As opposed to CDs, which for the same time frame could be close to about the 3% to maybe 3.5%, which is roughly half the guaranteed yield more. Also, Treasury notes, which are the U.S. Treasury securities that have durations between 2 years and 10 years, currently yielding roughly around between 3 and 4% as well. So it's also worth noting that MYGAs do offer compound interest just like a CD, as opposed to bonds that only offer simple interest, but might still be attractive if the guaranteed interest rate, also known as the coupon rate, is actually good enough. All right, now let's move to fixed index annuities. Right now, all right, so when it comes to fixed index annuities, here are the basic characteristics of them. The interest they earn is based on changes in a market index, which measures how the market or part of the market performs. It's not actually invested in an index. Rather, it's what they call linked, or it mirrors an index. Now, the interest rate is guaranteed to never be less than 0, even if the market goes down below 0, which is a fancy way of saying that the principal investment is always guaranteed. Although you should know that if the index that your money is linked to does not, it actually does a 0 return in any given year, and your money just at that point just doesn't grow for that year, it can still actually be reduced by the cost of any fees, if any, that are part of that annuity. So it's always a good idea to make sure that if there are any fees involved, that they are worth taking on. Now, annuitization is an option for FIAs if you were inclined to go that route. However, the reason why most financial advisors would prefer an income rider over annuitization in a fixed index annuity, even though both will provide income for life or for some other designated period of time of the annuitant's choosing, is because an income rider will provide a guaranteed minimum income amount that will be paid in the future, which makes it possible to plan in advance based on that number. On the other hand, with annuitization in an FIA, because you're not getting a fixed rate of return, you don't find out how much you're going to get until the time when it's exercised, which makes it much less possible to plan in advance for. Finally, these days, many FIAs have been created just for the purpose of investing due to the purpose of protected, moderate, conservative growth that they provide. However, these types of FIAs generally do not have an option to purchase an income rider, but they still could be annuitized if someone wanted to do so. They are sometimes also referred to as investment annuities or bond replacement annuities as well. And they have actually become pretty popular over the last 10 years or so, since government bonds and CDs have yielded so much less than they used to at that time. But actually now they're starting to come back up. In fact, At one time, long-term U.S. Treasury bonds could be relied on for an average of 5% plus. But since January 2008, until up to about 6 months ago, they were only averaging about 1.9%. Now, they are starting to come back up due to bonds, but it's going to take a while to pull that average up, which is a significant loss in yield for a long-term investor, especially if they're retired and need to play it safe. Conversely, based on simulated returns from 1927 to 2016, it was found that net of fees, fixed indexed annuities had an annual return of 5.81%, compared to 5.32% for long-term government bonds over that same time period. So it's easy to see why FIAs have become a natural alternative to investing in government bonds over the last few years. Now, the final type of annuity that we're going to discuss is a variable annuity. So when you purchase a variable annuity, the money you pay is actually allocated to an investment portfolio. So you'll have several options for investing the funds in that portfolio. And these options are called subaccounts. And they can include stocks, bonds, money market funds, a stable income value mutual fund, and various other types of funds. Also, if you invest in a variable annuity to later annuitize it for an income for life, the amount of the income you receive will rise or fall depending on the performance of the portfolio. So these are not for people that are looking for or need a consistent income amount every month. However, they could be good for someone who has maxed out all of their sources of tax-deferred vehicles like IRAs, 401ks, Roth accounts, and is looking for another tax-deferred account that has no limits to contribute to. Although the federal government still charges a 10% early withdrawal penalty on them for anyone who withdraws from them before the age of 59 and a half. So now that you have a better understanding of the three main types of annuities and how they work, now let's talk about some of the other things that you should know more about when it comes to them. These are things that may or may not apply to any given annuity, but are universal in the sense that all insurance companies that sell annuities may or may not include them in one or more of their policies. The first thing on that list for us to discuss is fees and how they may or may not be incorporated into any given annuity. And you heard me right when I said may or may not be a part of any annuity due to some don't actually charge any fees. Let's take a deeper look at that now. Okay, so when it comes to fees and annuities, there are several types that are common when it comes to them. Let's start with fixed annuities. Bullet point. Come on, guys, get out their notebooks. Jot this down. This is bullet point number 3. They usually do not charge upfront or annual fees. Let me say that again. Fixed annuities don't usually charge any upfront or annual fees, but instead they'll reduce their guaranteed rates as compared to what the market bears, which will allow them to apply the difference to any interval fees that are incurred. Now, as far as fixed index annuities are concerned, they too usually do not charge upfront or annual fees for their base contract, but instead they charge rider fees. And the riders are used to enhance their returns, sometimes drastically. So much so that it almost doesn't make sense to not purchase the rider. For instance, I've seen income riders that offer a potential increasing income that is linked directly to the same index that the cash account is linked to, thus making it possible for the annual income to increase beyond what inflation bears, or even at the rate of inflation if you choose that option, which is which is a very valuable feature, one that is very difficult to turn down. You'll see income rider fees that are usually around 1% annually, though. Liquidity rider fees that are usually around half of 1% to maybe 60 basis points, and even indexing strategy fees for historically well-performing actively managed indexes that are offered that can run anywhere from 1% to even 1.75% of any of the assets. And they're all any of the assets that they're actually linked to. I mean, this is just to mention a few because there are many types of riders available and associated with fixed index annuities. And we're actually going to discuss several of them shortly. Next, when it comes to the fees related to variable annuities, they get a little bit more involved. Here are the most common ones. Variable annuities tend to see the most fees. The first is what they call the mortality expense fees, also known as M&E fees. This is an asset-based charge applicable to only the variable subaccounts that usually can't increase during the life of the contract. It covers death benefit costs and the guaranteed ability to annuitize at a rate established in the contract at the time of purchase. This fee can cost up to 1.5% of the account value annually, just on its own. Also, you'll usually see what's called an administrative fee. This is also an asset-based charge covering the maintenance of the contract, including record keeping and other administrative expenses. You can expect to pay up to 0.3% of the account value annually for the administrative fees. Now, next is what they call an investment expense ratio fee. Thus, is an investment advisory or management fee. It's also an asset-based charge used to pay the portfolio managers of the sub-accounts. You can expect to pay up to 2% of the total value of the total value of the assets annually on that one. There are also some common optional fees. One is an income rider fee that's called a guaranteed lifetime withdrawal benefit fee. This is an income rider that is similar to the fixed index annuities income rider. Annuitants can expect to pay up to 1% of the account value annually. Another is called the enhanced death benefit rider fee. This is an optional estate planning rider to protect the annuities owner's beneficiaries' investment. The cost can be up to 0.5% of the account value annually. So these are the most common fees associated with the types of annuities that we've discussed. Now let's take a look at the most common riders that are seen with them as well. Some of the most common riders with these annuities are as follows. But before we actually get into that, let's first define what a rider is, just in case you don't know. It can also be referred to as a floater or an endorsement. And simply put, it's an optional add-on to an insurance policy. Also, so you know, its opposing cohort is something called a waiver. And it is, and simply put, is the surrender of a right or privilege within a policy. But we're not actually going to get too much into waivers. Just wanted to explain that a little bit. So here's our list of the most common riders that we've seen. The first is called a guaranteed withdrawal benefit. It provides for immediate withdrawals from the invested balance without having to annuitize the investment. It's usually a predetermined percentage, somewhere between 5% and 15% of the total investment in the annuity. Second, is one called a lifetime income benefit rider. It guarantees that you will receive regular income payments from the annuity that will continue for the rest of your life, even if the actual balance of the annuity is fully depleted. And you will know what that amount is in advance. Next, it's called the death benefit rider. It guarantees that your heirs will receive at least the amount of the premium that you paid for the annuity, but usually no additional return that is made on it. Next, it's the long-term care rider. This rider provides for the reimbursement of long-term care related expenses up to a predetermined amount over a predetermined time period. The time period can be both finite and infinite, so depending on how the policy is structured. The next is called a cost of living or a COLA rider, and it provides for increases in the monthly payments based on a measure of inflation, which it can be based on and usually is either the consumer price index or just a specified percentage that is agreed upon in advance, which you'll usually see somewhere around either 3% or 5%. The next is a refund or return of premium rider. It provides for the return of invested funds to the named beneficiary in the rider in the event that the annuity owner dies before the principal value of the annuity has been paid out completely. Some may even include interest on that invested amount as well, but most actually don't. The seventh one is the waiver of premium rider, which most commonly seen in long-term care or disability policies. It provides for premiums to discontinue, so you don't have to pay for it for a certain period of time when certain conditions are met, like a disability or not being able to perform 2 or more of the activities of daily living. However, if it is a short-term disability policy, once the insured is no longer declared disabled, then the premium will no longer be waived. The eighth one is the liquidity rider. It's called a liquidity rider. This is a really common one. This rider provides that after a certain period of time, usually 2 to 4 years, the full premium can be liquidated without interest. So you don't get the interest on it, but you can get the full premium that you put into it, minus any withdrawals without any surrender charges, which we'll discuss in a minute. The ninth is called the commuted payout rider. This is an interesting one. It enables you to withdraw a lump sum from your annuity without any surrender charges applied. It's always a predetermined percentage of the cash accumulation value, though. And the 10th one is a guaranteed minimum accumulation benefit rider. This rider is most commonly seen with variable annuities, and it guarantees that the minimum amount received will be the dollar amount invested into the contract or the gain in the value of the contract, whichever is higher, between the time that it's established and when it begins making income payments. And the final rider that we're mentioning, man, this is a heck of a list. The 11th rider is called the guaranteed minimum income benefit rider. The guaranteed minimum income benefit rider, it ensures that the annuitant will receive a specific income payment regardless of the performance of the annuity from the time that the contract is put in place. So these are some of the more popular riders that we see, but there actually are many more, believe it or not. And always new ones being created by the various insurers out there today. Now let's discuss the various options available for interest to be attained in these annuities that we've been looking at. Okay, there are several different options in which assets that are invested into these various annuities can grow or be credited, which is the technical term that is used when discussing the return that annuities get. We call it being credited. First, in fixed annuities, like we discussed before, there is a guaranteed rate of return. That is a predetermined upon purchasing. So there's a guaranteed rate of return that you're going to know before you even purchase it. The assets are invested into the insurance company's what they call the general account, which normally is invested into either government bonds or the highest quality corporate bonds available. Next, when it comes to fixed indexed annuities, there are usually a dozen or so options to choose from when it comes to pursuing growth on your money. The first of which is called a fixed account, and it usually is the equivalent of investing into short duration bonds or CDs. Today's range being anywhere from actually 2 to 3%. The remainder are usually variations of 5 or 6 different indexing strategies that are based on either actual stock market indexes like the S&P 500, the NASDAQ, and the Dow Jones Industrial Average, or have been other ones that have been created just for the use in some indexed annuities, usually by the insurance companies themselves and or in conjunction with a third-party mutual fund company, money manager, or consulting firm like Morningstar or American Funds or Fidelity or PIMCO, other companies like that. So when it comes to these indexing strategies, they are usually named after the index and terms that they offer. Then they will also be given terms related to how the return that the index generates will be applied. For example, if you look on this chart, you'll see it says the anniversary information on it. The second line down under the fixed account, it refers to the indexing strategy that is offered as the P2P S&P 500. This is the annual point-to-point S&P 500 index that they're offering. It then proceeds to show the terms that they are offering it at for the upcoming year. As you can see, the starting point is in this particular slide, 4,300.46. There is no index margin or spread. It has a 20% participation rate, which means that whatever the index does, the annuity will receive 20% of that. Then there are no strategy fees, caps, or interest credit factors. So as you can see, each available indexing strategy comes with its own index it's related to and terms as to how often it will be credited, which is either every year or usually every 2 years. And whether it offers a margin, which is a spread, a participation rate, which is up to that specific percentage and nothing beyond that, a cap percentage, which means that they will not only apply a return up to that rate, but nothing higher than that, or whether they are charging a fee for the specific indexing strategy or not. It's all laid out for you in the annual statement that is received every year by the annuity. One last thing I must mention when it comes to fixed index annuities. Even though the principal investment is always guaranteed and can never go down due to market or index performance, which includes the gains they earn as well. You can't ever lose any of the gains. It could still lose value in a year when it gets a zero return or credit if it has a rider fee that is charged to it. So if you invested $100,000 in a fixed indexed annuity, and the first year you made $10,000 in return, but the second year your index actually had a negative return, your account balance would stay at $110,000 based on the index. However, if you had a 1% income rider fee, that $110,000 would actually be reduced by $1,100 to $108,900 due to the fee being deducted. So you can't lose any money from the index or the market related investment that it's linked to. But if there are fees, you can lose some on a year where you don't get any crediting. Now, when it comes to variable annuities, they actually do invest the assets into the various types of market-based investments, like mutual funds, money market funds, stocks and bonds, etc. But as I mentioned before, they are referred to as sub-accounts instead of funds or stocks or bonds. Of course, these sub-accounts work just like any other market-based investments. The principal can be depleted as the result of the performance of the sub-accounts. So it is possible in a variable annuity to lose the full value of the account if someone was making withdrawals at the same time that the market had a major correction, because remember, this type of annuity is the only type where the principal is not protected from the performance of the investments inside of it. Now, the last thing that I want to mention about indexing strategies that are offered with fixed indexed annuities is that you have to keep an eye on them every year or two, depending on when they're crediting, when their credits are applied, because the insurance companies are not obligated to offer you the same terms on them once this occurs. They reserve the right to change those strategies based on whatever current market conditions are. This means that the terms of the indexing strategy can either, that your money is gaining interest from, can either improve or worsen based on current market conditions. Uh-oh. Almost there. I almost was through it. Now, to be fair, though, it's been my experience that all the insurance companies that I have dealt with want to offer the best returns to their customers. So rates move up as much as they move down. It is purely market driven. Also, at the time of these periodic changes, there may be some new indexing strategies that the insurance company is offering that have better potential returns than the one you started with. So you really need to keep a close watch on these year after year, because you can only get a 3 or 4 week window right around your anniversary date for you to change, for you to make changes to them, which most of my clients know that I recommend doing from time to time. All right, that covers the options for growth in these annuities. Now let's move on to discuss the penalties that can be incurred with them. Okay, when it comes to penalties inside of an annuity, it is pretty straightforward, actually. Every annuity has what is called a surrender period. This is a period of time that lasts usually between 1 to, I've seen, as long as 14 years, depending on the type of annuity it is. During this time period, if you withdraw more than what is known as the penalty-free withdrawal amount, which is usually between 5 and 15%, then you will incur what is known as a bullet point. This is bullet point number 4. Write it down. You will incur what is known as a surrender charge. So remember that. That's what it's called for any type of withdrawal that exceeds the free withdrawal amount in that certain surrender period. So write that down. Bullet point number 4, surrender charge. This is a charge that is only applied to the amount that you withdraw above that penalty-free withdrawal percentage. So if you had, say, $100,000 in an annuity and it had a 10% penalty-free withdrawal percentage, you could take out $10,000 without a penalty. But if you took out $12,000, then the extra $2,000 would incur a penalty to be deducted from your account, not your withdrawal amount. However, after the surrender period is up, you can take out as much as you want, whenever you want, and there will no longer be a penalties involved. Now, the only other potential reduction that could apply to withdrawals that exceed the penalty-free withdrawal amount is what's called a market value adjustment, or MVA. Really want to pay attention to this. However, this could also actually cause an increase in your withdrawal amount or your benefits or your accumulation account, because it's based on whatever current bond interest rates are compared to when you made your investment into that annuity. So if rates are down from when you purchased it, then your withdrawal amount will actually be increased. But if they are up from that time, then this will decrease your withdrawal amount and thus cause you to need to withdraw more to get a specific amount out at that time. Now, the last penalty that could occur and is completely unrelated to the individual terms of the annuity between the insured and the insurer is if someone who owns the annuity is under the age of 59 and a half and decides to make a withdrawal. Since it is an investment vehicle that the government allows to grow tax deferred, just like an IRA or a 401k, a 10% early withdrawal penalty will be assessed by the federal government if it's taken out before the age of 59 and a half. All right, that covers all the potential penalties. Now let's move on to what's called a bonus and discuss whether it is real or not. Bullet point. Come on now, get those notebooks out. This is bullet point number 5. So, what is a bonus inside an annuity? Well, it is simply extra money that the insurance company will credit to your accounts in order to boost certain accounts and income values it offers. I get it. That seems a little too good to be true, right? And to some degree, it actually is. However, to explain bonuses better, what I tell people is that bonuses are used by insurance companies to entice people into investing into whatever specific annuities and life insurance related products that they are looking to push at any given time. They do this when they are trying to gain market share with different products. Then once they accomplish that, they always discontinue the bonuses, so they are not always available. That's why I tell people to get them while you can. Okay, so when it comes to bonuses, there are basically three types that I've seen. The first is called a premium bonus. And this definitely is real because it is actually cash that they will add to your cash accumulation account. And at a later date, it can be actually accessed when you withdraw your money after the surrender period. So for example, if you were to invest $100,000 at certain times, there could be a 3% or a 10% bonus. Let's call it a premium bonus. So you put in $100,000, and if it was 3%, you would actually show $103,000 in your accumulation account. But you can't actually take it until after you get out of the surrender period. The second is called an income account bonus. And it only adds cash to what is called the income account on annuities that have income riders. This cash cannot be accessed in a later lump sum withdrawal. So in some ways, it isn't actually real. It basically just serves to raise the amounts of your income rider payments whenever you choose to activate them. So it is real that you will receive higher income payments as a result of it. And the third is something that's called an income account roll-up. Again, this is only applied to income accounts inside of annuities that have income riders. This is a guaranteed rate of return that is, again, only applied to the income account of an annuity with an income rider. These, also called roll-ups, can range anywhere from 3 to 10% that I've seen, and can be added for up to 20 years. I've seen actually prior to activating an income rider. Then once the income rider is activated, they stop being applied to the income account. Again, these just serve to provide higher income payments at a later date. So if you're not aware of how most income riders work, let me explain that once someone purchases an income rider, there then becomes two different types of accounts that are tabulated within the annuity. One is called the cash accumulation account, which is your actual cash that is applied interest credits based on either the indexes it's linked to or the sub-accounts it's invested into, if it's a VA. And the second account is also known as an income account. This is the account where your income rider payments will be withdrawn from. This is also the account where the income account bonuses and guaranteed roll-up rates are added in order to beef up your future income rider payments. All right, that's enough about bonuses. Let's move on to our last detail related to the internal workings of annuities. And that's what's called a payout percentage. Well, the last piece of the puzzle that you definitely need to know when it comes to income rider-based annuities is bullet point number 6. Get those notebooks out. Bullet point number 6. And that is called a payout percentage. What a payout percentage is, it's a percentage at any given age, because this is the maximum percentage of the overall assets that the annuity, that will be paid out every year as income to the annuity. So let me read that one more time. This is only in an income rider-based annuity. It's something that's called a payout percentage. What is a payout percentage at any given age? Well, it's a maximum percentage of the overall assets, however much money's in there, in the annuity, that will be paid out every year as income to the annuitant. Now, this is a huge deal because an insurance company can give you $1 million income account bonus if they want. But if they're only offering a 1% a year payout percentage, then you're only going to get paid $10,000 a year from it for the rest of your life. But if they're offering a 5% a year payout percentage, then you'll be getting $50,000 a year for the rest of your life. That is a huge difference. As you can see in the chart below, that these two different insurance companies are offer different payout percentages at the same ages. The one on the left at age 65 offers a 4.5% payout percentage versus the one on the right offers a 4.10% payout percentage for a joint annuity. That's roughly $2,000 a year difference. Remember, every little bit adds up. Also, as far as annuities go, these two are actually pretty close to each other. I've seen others where one pays out 5% and the other pays out 4% at the same age. That could be a $5,000 a year difference. So don't forget the payout percentage. That's an extremely important thing that you want to know if you're purchasing an annuity for income purposes. So don't forget to always look at the payout percentage, because inside income-based annuities, it is king. Okay, now that we have looked at some of the most internally important things related to the various types of annuities, let's talk about one of the most important externally related things. And that's the rating of the insurance company that you purchase your annuity from. So when it comes to insurance company ratings, they are based on the company's ability to pay its claims. So the higher the rating, that the company can pay, the higher the rating, the higher the volume of claims that a company can pay at any given time. However, when it comes to annuities, the length of time you will be committed to it will depend on your purpose for investing into it. So if you're investing into a 3-year, multi-year guarantee annuity, also known as a MIGA, and a company that has a lower rating is offering a higher rate on your money, then they might be a viable consideration, because 3 years is not a long commitment. So in that situation, a B-rated company could definitely be worth considering. However, if you're looking to invest in an annuity that can provide you an income for life, which is obviously a much longer commitment, then you should consider going with at least an A-rated company, because they are more likely to stay in business longer than the B-rated company, even though it isn't very often that A or B-rated companies go out of business. The two most common insurance company ratings companies are AM Best, which has the highest rating of A++, and Standard & Poor's, who has the highest rating of AAA. All right, at this point, we've discussed what are the most common annuities in use today, and what I think the major considerations are when it comes to them. Now let's take a look at some scenarios that I've used annuities for and why. Okay, folks, these numbers are from an actual client of ours. When we first met, and when we first met her, it was roughly about 2 years ago. This is Sue Smith. Of course, we changed her name for privacy's sake. You can see that Sue had a total of $328,000 at that time, and she was age 61. She's planning on retiring at age 67, and at that time, her Social Security will be approximately $2,991 a month. And as you can see, she does not have a pension. Now, what stands out most in this scenario is that her monthly expenses are going to be more than her monthly Social Security payments. Not much more, but roughly around $459 a month. This is what we call an income gap. As soon as we see this, we automatically think about trying to fill that gap with an income annuity, if we can. And that is exactly what we did with her. We used around half of her assets to produce right around $900 a month to fill that gap. Now you're probably thinking, why didn't you just buy an annuity that would have filled that gap exactly? The problem with that is that in our financial planning software, we have her monthly expenses programmed to increase by 3% every year due to inflation. So when we ran the numbers for that annuity to just fill that gap, it failed to provide enough income long-term to fill it. In fact, this particular income annuity also has a market-based increase that is applied to the payment annually based on how well the indexes that are linked to it perform. We factored it into increase by approximately around 3.88% a year, which was based on the 10 worst years of the last 20 years of the historical performance of the index. So now let's take a look at how it played out inside our retirement planning software. Okay, how this works is that we first had to enter all of her personal information into our financial planning software. Things like her date of birth, desired retirement income, amount of Social Security, pensions, if she would have had one, her fixed expenses, her estimated one-time expenses like a new car, vacation, holidays, home repairs, etc. Her debt like mortgages and credit cards, school loans, etc. Also, the amounts that she has in each of her investment accounts had to be entered, like what was in her 401ks, IRAs, brokerage accounts, etc. And then their average long-term returns were entered. Her estimated effective marginal tax rate had to be figured out and added into the software as well. All that information was entered into the software before we could press one button that is called the what if button, which then will tell us, based on what's called a Monte Carlo simulation, what the percentage chance of success that she has for her portfolio to last until her life expectancy, which is in this case around 84 years old, according to government mortality tables. Well, as you can see, based on the photo on the left, when we did that, it told us that her portfolio had a 78% chance of it lasting. So because she had that income gap, we decided to implement an income annuity that was available to us at that time. And once we did that and retested it, as you can see, we did on the slide on the right side here, our software was then reading that her money had a 100% chance of lasting. This was how we knew definitely that the income annuity was a good choice for her. Now, it does not always work this well. It depends on the size of the income gap, and if we can find an annuity with an income rider that pays out enough to fill the gap without costing too much to do so. Now, the market conditions usually dictate that to us as well. So income gaps are definitely one of the main situations we look for when considering an income annuity, but it is definitely not the only situation where an income annuity should be considered. Okay, now let's move on to our second and final scenario. This one discusses when a good time to consider an investment-based annuity is. Okay, this scenario was also from another couple that became clients not long before the last client from the scenario one. He was age 65 and she was age 62. They had a total of $670,000 in assets. Their total combined Social Security and pensions added together were $6,300 a month. But this time, their total monthly expenses were less than their total combined incomes. This is a situation where there is no income gap. So then the next things we look for is how well their portfolio will perform under what's called a market-based stress test. When we tested their portfolio to see how well it would hold up, if there were two major market conditions over the next 20 years in their retirement, we found that it would hold up, but that it wasn't going in the right direction because of the risk level of the investments that it was invested in at that time. So the challenge with pulling back the risk of the portfolio these days is that the traditional way that we would do this in the past year, in the past, was to just move a larger percentage of the assets into higher quality government bonds, which of course are not principally protected, which many people recently have realized due to the Fed raising the fund rates so quickly this year. The long-term treasuries have been had gone down as much as 35% this year. Now, historically, they have averaged right around 5% since their inception in the late 1800s until right around 2011, when they started to go downhill fast. Now, over the past 10 years, long-term government bonds have only averaged a little over 1.9% prior to this year, where they're finally coming back up. So in order to make up for this, many financial advisors have started to incorporate fixed index annuities to make up for some of those long-term bond deficits. In fact, not long ago, some studies were actually published by a pretty reputable professor from Yale named Roger Ibbotson, where he back tested both bonds and fixed indexed annuities all the way back to 1926. And he discovered that the FIAs had overall averaged 5.81% versus 5.32% for bonds. However, that study was done in 2016, and it didn't include the bond rates for the last 6 years, which have been the lowest in the entire history of bonds, again, prior to the last 6 months of this year. That all being said, Ibbotson also made a recommendation at that time for everyone to start adding FIAs into their portfolios as a third non-correlated asset class, meaning that the performance of the FIAs did not directly go up and down at the same rate as stocks and bonds did in their respective markets. So that is exactly what I applied to this client portfolio. It ended up being a 40% equities, 30% short bonds, a combination of short government and corporate bonds, and 30% into a fixed index annuity. Let's take a look at how that combination of asset classes played out in our planning software, where it compared to what they had. Well, as you can see, the photo on the left, which was their original portfolio, has a steady decline of assets up until their life expectancy. And the photo on the right, which was the new 40% equities, 30% short bonds, and 30% fixed index annuity portfolio, has a steady incline of asset growth. This is mainly because adding the FIA to their portfolio allows it to reduce the overall volatility and downside potential. At the same time, it brings back to the portfolio a higher upside potential than it would have had in those days if it was just left in a 60% bonds. However, now that bond rates have come back up, a 40% equity, 60% bond portfolio would probably play out better in our software, but the principal still would not be guaranteed like it would be in a fixed indexed annuity, which then comes down to each individual client's risk preference. So after testing and comparing these two different asset allocations, we knew that the implementation of the FIA was going to give their portfolio the additional protection and potential performance that it would have been lacking with only bonds as the alternative investment to the equities portion of their portfolio. And that is why we recommended and implemented it at that time. Well, folks, that was our last scenario. I can't tell you how much fun I had presenting them to you, and I hope that you now have a better idea of all the considerations that go into whether an annuity is right for retirement plan or not. So that concludes the learning portion of our webinar today. We sincerely hope that this annuity information and considerations that we've discussed with you today are as helpful to you as they are to us when putting them into a plan. Also, before we jump into our 6-question quiz and our Q&A for it, I want to make a special offer to everyone that is attending our webinar today. So just for everyone here with us on this webinar today, I am offering a complimentary, no obligation annuity review analysis. Plus, in order for you to do this, I have posted a link for a 60-minute Zoom meeting in the comment box below. All you have to do is either click on that link now or copy and paste it to some place where you can get to it after this webinar. This way you can book a time that works best for you directly on my calendar without any need for us to discuss it in advance. However, we will reach out to you to confirm the meeting not long before it. Also, I want to take a minute to explain a little bit about what the review entails and what you can get out of it. So this is what it entails. First, there's 2 ways you can actually meet. We can actually meet to do it. The first is online using Zoom, which is almost just like how we are doing this webinar, but instead we'll both be able to see each other and hear each other, and it will be completely private. Or we can meet in person at our office in Fort Washington, PA. People do that now. They do meet in person still. We're back to it anyway. It's just off the PA Turnpike. And so if you prefer to meet in person, we can do it that way. Again, in order to schedule it, I have posted a link in the comment box for you to book it on my calendar at your convenience. Next, the review itself is a 2-step process. First, we meet to gather all the information that I will need to do the review. Second, we meet a second time to go over the results of it. And finally, what you can get out of this is a clear understanding of whether any of the annuity considerations that we discussed today can be applied to your plan in a way to help improvement. Okay, folks, we're now going to jump into our 6-question quiz and our Q&A session before we wrap things up. So let's do it. Okay, I'm going to open up the Q&A so I can see who answers what. Let me take a little sip of water. Let's jump in. Question number 1. What risk does an annuity protect people from? Remember that bullet point? What risk does an annuity protect people from? That's pretty darn close, Angie. Anybody else? Outliving their income. Good one, Patsy. That's the answer. You got that one, Patsy. Marking your name down. That's what Rachel usually does. Okay. Second question. What are the most commonly used annuities today? There's three of them. What are the most? Just name one. Just got to name one. Fixed income annuity. You got it, Angie. Let me write it down. Angie. Also, I want you to put in here what store you would like your gift card from. Question number 3. What do fixed annuities usually charge for fees? Fixed annuities. What do they usually charge for fees? Getting a little harder. It was the first kind. And remember, this kind gives you a guaranteed rate, and there's no riders or no usually you can only annuitize them, which doesn't cost anything. Come on, somebody take a shot at it. Yes, Angie, you got it. Frank, you got it too, and so did Patsy. All right. Writing that down. Okay. Fourth question. What is the charge called that is assessed to an annuity withdrawal that is above the free withdrawal percentage during what is known as the surrender period? There's a hint right in there. What is the name of that charge? What is the charge called that is assessed to an annuity withdrawal that is above the free withdrawal percentage during what is known as the surrender period? You're too quick to the trigger, Angie. I think we're going to pass that one on to Paul. I hope you're okay with that. Also, okay, question number 5. What is it called when an insurance company credits extra money in an annuity in order to boost certain accounts and income values inside of it? Oh, Angie, you're just so quick. I think I'm gonna give that to Frank. I hope you're okay with that. Final question. What is the name of the percentage of the overall assets in the annuity that will be paid out every year as income to the annuity? It's a blank percentage. Yes, good one, Angie. You got that one. Good job. Angie really is quick to the trigger. Good job, though. That was pretty good. We have Patsy, Angie 3 times, and Paul and Frank. Good one, guys. Good one. Okay. So now we're going to open it up for a little Q&A. We got a few minutes to do it. And if anybody has any questions, you can shoot them out now. I do have a few that are in the in the email. I'm going to start with one from there. Okay, question number one. What is the longest surrender period that you recommend entering into an annuity? All right. Well, okay. So that's, it depends on what the annuity's for. Generally, I don't like to see go deeper than 10 years. But I have seen some income-based annuities where they go out 14 years, where the income payment can be, be a higher payment if you're willing to go deeper with the percentage. And if it's income for life, that could be an acceptable length of time. Although I try like heck, and I actually don't, I really don't even consider them much. But at one point in time, I did when it was worth it for the amount of a payment. All right. Anybody else? All right. Next one from the email. Do you think a variable annuity is a good long-term investment? Well, again, there's a time for each type of investment vehicle that's out there. I do think it can do as good as a mutual fund in return. It does have more restrictions, and it usually has a good bit more fees. The only time I could see really considering it and I've never actually had a client that fell into this, but is when you have a client who is a real high net worth client who's exhausted all their other deferred income market-based investments. And now at that time, you may want to consider it, not so much for an income, but more so for an investment that's tax deferred. But that's really one of the only times I can think that it really can make sense. All right. Next question. Which insurance companies have the best annuities? Now that's really too tough to answer. At any given time, annuity companies enhance their products in order to gain market share. Generally, advisors like myself will get notices through email to let us know when that happens, when the terms are more favorable than others. So I prefer an A-rated company if it's a long-term based annuity. If it's a shorter term, like a MIGA, a multi-year guaranteed annuity, anywhere from 3 to 5, 7 years, then maybe a B or B plus company could be good. Final question. What do you think is one of the most important facts that people should know about annuities? Well, probably one of the most important things that I think people need to think about. There's a couple, there's a few, but one is that, those indexes, if it's an indexed annuity, fixed indexed annuity, the indexes are not guaranteed for life. The terms can be more favorable sometimes than others. Another important thing is that there's something called a set point, they call it, or a reset point. So for a fixed indexed annuity anyway. So for example, the first year you invest into that annuity, if that index, let's call it the S&P 500, and the one example we had in there was that it was at 4,300 and some change. If the next year that index on the anniversary date is when you get credited. If it's at, say, 4,500, then you're going to get return because it's higher than what it's at. If it's below it, you're not going to get any return. But what's important to understand, the big difference between this and a variable annuity, is that the next year, the starting point is no longer 4,300. It's whatever the index was at that next year. So if it was, say, 4,200, you didn't get return, but your new starting point, that's called the reset, is it, say, 4,200. So you don't have to make up for that other loss. You don't have to make up for the 4,300 every time. Where it's different in a variable annuity, you have to make up for that in order to be able to keep getting gain. I think that's an exceptional point that I think people should know about. All right, folks, let's see here. I also posted the resources to this that I used for this to create this presentation in the comment box. You can copy and paste them if you want. All right, that includes our workshop for today. I just want to thank you, folks, for being the type of people that would attend this type of workshop, because it says a lot about the type of people you are to spend your precious time learning about this important topic. I truly commend you for that. I want to remind you that if you have any questions related to this topic we've covered today, or our offering of the complimentary no obligation annuity review analysis, or if we did not answer your question, you have one now, one pops up in your head later on, or anything else for that matter, and you'd like to discuss it with me further, I will also be putting up, in fact, I already did put up a link for a complimentary 15-minute Q&A phone call meeting with me. So then you could schedule that and we could talk on the phone and I could answer whatever questions you have. Also, if you're looking to get in touch with us for any reason, you can reach us by phone at 215-804-9708. By email at info@plcfs.com. That's Paul, Larry, Charlie, Frank, Sam.com. Or to make it even easier, just go to our website at plcfs.com. And all our information is always there. Also, please mark Tuesday, December 27th, 2022 at 7 p.m. on your calendar for our next webinar. We will be announcing our next topic soon. Remember, we do our webinars on the last Tuesday of every month. With that said, have a great rest of your week and an awesome holiday season, and we will see you next month. Good night, folks.